Good morning, everyone, and welcome to the first Wednesday morning seminar for June, in which we are talking about insurance and contract administration, what you need to know, with Mr. Jon Sharp, consultant solicitor who's currently sitting in sunny Scotland, sipping his tea, where I believe the weather is equally as good as it is down here. So, Mr. Sharp, it's over to you. And then I'm sure you'll answer any questions at the end.
Okay, thank you very much. Morning, ladies and gentlemen. Thank you, Julie. Insurance and contract administration, what you need to know. I think at the moment, insurers' reputation is probably at an all-time low with their perceived refusal to pay the business interruption claims. However, you should always bear in mind that there's a great many occasions when insurance policies do respond and do save businesses. A client of mine recently installed some pods. Unfortunately, 2 of the pods leaked to newly decorated and improved premises below, caused about £500,000 worth of damage, but their insurance policy did respond, and as a result, they basically it saved the company. So there are always 2 sides to things. That's me, enough about him. All my details are on the website. I'm going to look at the 3 important principles: the reform of the Marine Insurance Act of 1906, the Third Party Rights Against Insurers Act 2010, a thing called CIDRA very briefly, the Insurance Act of 2015, Warranties and Frauds, a couple of case studies, look at construction insurance, and some top tips for getting your claim paid. There's 3 important principles which I think everyone always needs to bear in mind. Irrespective of any changes in the law, insurance is a policy of indemnity. It's designed to put the insured back into the position they were immediately before the insured event occurred. So not better, not worse, in the same position. Second thing to remember is that insurance is a contract between the insured and the insurer. Therefore, the insurance policy terms and conditions are important. I'll come on to that a bit later. And your aim has to be to ensure that it's got full cover for any eventuality. So I hope I said at the beginning and demonstrated proper insurance can save businesses. Just a little history. Insurance in this country was effectively governed by the Marine Insurance Act of 1906 until the Law Commission decided that it was unclear and unfair and archaic, even though by the time, certainly by 2010, just about every clause had been litigated through the courts. Everyone had a good understanding of what the Act meant. But no, the Law Commission decided it needed reform. Remember that the London insurance market has global influence. It is still the third largest insurance market in the world. And therefore, the regulation of insurance is important. Anyway, the Law Commission, instead of having 1 act, introduced 3 new acts. The first, the Consumer Insurance Disclosure and Regulations Act 2012, or as we call it, CIDR. The Third Parties Rights Against Insurers Act 2010, which was enacted in 2016. The Insurance Act of 2015. And then I shall mention very briefly as an afterthought, a new section about insurance was put into the Enterprise Act. That section has now been incorporated into the Insurance Act of 2015. I'll mention that briefly at the end. So that's your statutory framework now. Under the old law, an insurance contract was described as, you'll pardon the Latin, a contract of uberrimae fidei, so utmost good faith. Both parties to the insurance contract had to demonstrate that they had acted with utmost good faith in the presentation of the risk and also in the acceptance of the risk by the insurers. However, what this meant was that all matters relating to the risk in any way had to be disclosed, even if, frankly, they were completely irrelevant. And if you didn't, underwriters could void the policy for non-disclosure and frequently did so. So let me give you an example. With a warehouse, and shortly, what happened was that, let's just say you had a flood in your warehouse and you had a fire alarm. Now, clearly the fire alarm going off is not going to do anything to assist with the flood. It's not a fire. Under the old law, if your fire alarm, even though the going off of the fire alarm could not possibly have stopped or assisted with the flood, if your fire alarm didn't work and you had said to insurers that it works at all times, insurers could avoid the policy. So there was a need for a little bit of change there. Most policies, by the way, still do not pay out on a claim because there has been some element of non-disclosure. A new act was brought in then. I thought I'd just mention this because it's quite interesting. There was a change in the law and the Third Party Rights Against Insurers Act 2010 was brought in. So a party who has a claim against an insolvent insured can cut through and recover relevant compensation from the relevant insurer. Therefore, the third party can contractually stand in the shoes of an insolvent insured, known as stand-in rights, providing it's an insured peril of the original insured. Now that's useful and interesting. There is a reasonable amount of insolvency in the construction industry. So say you had a company and they caused damage to some premises, but they went bust before they could make a proper claim on their insurance, assuming they had insurance. The fact that that company has gone bust does not prevent somebody else, so someone who has possibly suffered the damage, standing in the shoes of the insolvent company and saying, I'm standing in his shoes, there was a valid claim capable of being made by the now insolvent company, I'm making it for them. So it's an interesting act. Excuse me, ladies. SIDRA, which was a law from 2013, I'm not going to touch on this because it only applies to consumer insurance contracts. So it's the policies that we all buy every day, you know, mobile phone insurance, motor, house contents, etc. It's unrelated to trade, the business, or the profession. Okay. But what is important, and what I'm going to deal with mostly today, is the Insurance Act of 2015, which was finally introduced in 2016, and it applies to all commercial insurance policies commencing on or after the 12th of August. It introduced a new duty for all non-consumer insureds, so for businesses, to make a fair presentation of the risk. And its whole aim was to try and make sure that insurers had less wriggle room, if you see what I mean, in the event that you had inadvertently forgot to make a disclosure of a relevant fact. This new duty, this fair presentation of the risk, replaced the old duty of utmost good faith. And your duty is to provide all relevant information, whereas before you were having to tell them everything. But you need to tell them relevant information in relation to the insurance that you want. But it's made clear that you need to involve all relevant senior management when compiling information for insurers. You've also got to state not only material circumstances that you know, but you ought to have known, bearing in mind the nature of your business, having conducted a reasonable search. And you must provide that information to the insurer in a reasonably clear and accessible manner. So, really, gone are the days, or should be gone, when you are providing insurers with absolutely every last piece of information about the business. That's not the duty now. The duty is that if you want to get cover for, I'm trying to think of something simple. If you want to get cover for, let's say theft, obviously, insurers may well want to know how many thefts have you had in the last 5 years, etc. Now, before, you'd have to tell them absolutely everything about the business to get that cover. Now, you could just concentrate on theft. We want cover for theft up to this amount. We haven't had any thefts in the past before. We always check our employees' credentials before they join us, etc. You wouldn't have to give them absolutely everything, chapter and verse. What is senior management? Well, it's anyone who has a key role in making decisions on behalf of the company. This may not actually be someone who has significant control on the day-to-day basis of the company. So, for example, the managing director. Clearly, you might need to speak to him, but very often when it comes to construction insurance, it'll be site managers, operations managers. It'll be these people who are working on projects at the moment, who can give the relevant information in relation to those projects that are being worked on. So it's not just your managing director, it's anyone who has any input into, for example, what's going on at any one particular construction site. You wouldn't talk to the managing director necessarily about that. He probably won't know. He'll have an idea. If you go and talk to the site manager and say, right, how many people are working on this site? Where are we? What are we doing next? Da, 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 da. You'll know. Material circumstances, well, that's anything that would influence the judgment of a prudent insurer when he decides whether to accept the risk, and if so, on what terms. So going back to my theft example, you want theft cover. Clearly, it's important that he knows how many incidents you've had of theft from your sites in the past. That's clearly going to influence his decision. If you have the most appalling record, he's probably not going to write the risk. If, though, you've had 1 2 years ago, he's very likely to write the risk. Know nor ought to have known, basically commonly available information that affects your business. So, new building regulations. You're expected to know when you make the presentation of potential change in the law. Okay, so new building regulations, you're expected to say to the insurers, by the way, you do know that in 2 years' time this is going to happen, or 6 months' time. Reasonable search, well, it depends on the nature of your business and the type of insurance you wish to buy and who is best placed to provide that information. So, going back to what I said before, the managing director may not have an in-depth knowledge of what's going on one particular construction site, but the site manager will. If you didn't speak to the site manager at all, then that's probably not a reasonable search. Reasonably clear and accessible, yeah, don't just shove it all in a carrier bag and send it to your broker and say, give that one. That's not how it's done. You also mustn't try and hide key facts amongst large amounts of wholly irrelevant material. Now, in practice, what happens is, as you know, a broker, will send you a proposal form, and then you fill that out and put attachments with it. But those attachments really should only be, and your broker will advise you on this, what's relevant to the risk you're writing. Now, you don't need to give them absolutely everything, but your broker will assist you on that. The Insurance Act 2015, if the insured, so if you fail to give a fair presentation, the insurer may avoid the policy as follows. If you have been deliberate or reckless, then the insurer can keep the policy, avoid the policy and keep the premium. In terms of deliberate or reckless, well, going back to my theft example, if you didn't tell insurers that in fact you'd had 20 thefts from your sites in the last year, that would be deliberate or reckless. If you didn't give the insurer information, so disclose sufficient information for the insurer, and he would have not written the risk had he known, so going back to the example, if he'd known about the 15 thefts, he wouldn't have written the risk, then he can avoid the policy, but he has to return the premium. In relation to all other breaches, if the insurer were to have imposed additional terms, they are imposed now from inception, or if a higher premium was to be charged, then the claim is reduced pro rata. So basically, deliberate or reckless or not have written the risk, the policy can be avoided. But for everything else, so effectively minor breaches, minor errors in making disclosure. So for example, you told insurers you'd had 2 thefts where in fact you'd had 3, that wouldn't avoid the policy. What the insurer might say is, well, if I'd known you'd had 3, I would have charged you a bit more premium. So I'm going to charge you more premium, and that's effective from the start of the policy, and I'm going to reduce the claim by the amount of the additional premium. Remember as well, the Act is the default scheme. If your insurers wish to contract out of it, so if there is a more disadvantageous term to you, they've got to take steps to bring it to your attention and ensure the term is clear and unambiguous. I put a note there saying probably not suitable for reinsurance contracts. I won't bore you with reinsurance this morning, it's way too early. But remember, insurers can contract out of the Act's terms. So just watch out for that occasionally. But again, your broker should advise you on that. Now, warranties and fraud. Any term that seeks to turn information provided when the policy was purchased into a term of the insurance policy will have no effect. So if you breach a warranty, the policy is now suspended while the insurance insured is in breach, but restarted when the breach is remedied. So let me give you an example. You have said to insurers that all the fire alarms on your premises work. In fact, you bought a dodgy bunch of fire alarms, you find that none of them have worked. What do? Well, you tell your insurer goes, okay, I understand, I'm going to suspend the policy while you install the new fire alarms, and when you've installed them, I'll reinstate the policy. Okay. What he can't do, you could do under the old laws, just say, well, that's it, I'm cancelling the policy, keep your premium. Doesn't work that way now. So warehouse example number 2, the flood and no fire alarm. Right, I mentioned this before, and now this new Act is in. The fact that the fire alarm didn't work would not now cancel the policy, because the fact that the fire alarm didn't work would have had no impact whatsoever on the damage caused by the water. Now, insurers, as I said, under the old system could probably have avoided the policy. Under this now, it's extremely unlikely that they would be able to do so. Fraudulent claims, obviously don't make them, it's a criminal offence. But if you do make a fraudulent claim, the entire claim that you've made is forfeit, including any honest parts of the claim, and the insurer can keep the premium. However, the insurer remains liable for any genuine claims prior to the fraud, but with the option to terminate the policy from the date of the fraud. Yeah, I think that makes sense. But insurers are now very, very hot on fraud. They do much more, they do a great deal more checks now on their insureds, and they're also part of network swapping information. So it's very unlikely that you will get an insurance policy if you have any track record whatsoever in relation to making fraudulent claims. I'm just going to look at a case called Ted Baker against AXA here, because I just want to highlight the danger about excesses. Excuse me, I think we all know what an excess is. So when you're renewing your car insurance, you're given a number of options. How much excess? How much can you pay in the event of a claim? That's basically what an excess is. And you'll have 500, 1,000, 50, and you pick one. And what tends to happen is the higher your excess is, the lower the premium you pay. But remember that your business has got to be able to afford those excesses. Now, let me just give you the facts of this case very briefly. There was a number of thefts from Ted Baker's warehouses of their clothes by a gentleman, unfortunately, called John. And John did this. He was a clever thief. And what he did was that he was stealing clothes effectively and selling them elsewhere from the bottom range, from the extreme size ranges. So most people are the average size, and therefore the clothes at the very large end and the very small end don't tend to sell. He realized this, and it was those he concentrated on. And over the course of, I think, it was nearly 10 years before he was caught, he stole millions of pounds worth of stock. He was eventually caught. He was prosecuted through the courts and was sent to prison along with 2 others. Okay. Now, Ted Baker had a theft policy in place with AXA. Now, you would have thought, wouldn't you, that actually, yes, there might be some arguments as to the amount of the thefts and what they actually cost, but you wouldn't have thought there's going to be too much argument about liability. Well, you'd be wrong. As the judge said, left no stone unturned and ignored all sense of proportionality and defended liability. They lost. The judge said, no, you're liable for thefts. There was then, though, a quantum hearing. So how much have you actually lost? And Ted Baker didn't do well. The judge held it was impossible to find any single loss in the series of thefts which exceeded the policy deductible. That meant that every time they took these clothes, the excess on the policy kicked in. It wasn't, if you like, just one swoop. They didn't, in 2006, just swoop a lot and go. That would have been one event, and they would have been all right, Ted Baker, probably. The excess, yes, they'd have had to pay it, but they'd have been all right. But because it was one taking every so often, the policy excess kicked in. Therefore, despite the fact that the policy clearly covered theft, even on the defendant's own case, so the AXA said, well, we accept that 2.1 million was lost. Ted Baker, because of the excesses on the policy, recovered nothing. You know, and this case, which I had a part in, the legal costs became phenomenal. But because of the excesses, Ted Baker did not do well. So remember, when you're trading your excess for lower premium, remember your business has got to be able to afford that excess. Okay. Ted Baker did appeal, and they actually were partially successful, and this is an important point to remember. The insurer or reinsurer has a duty to spell out to the insured or reinsured that his actions or inactions during the process may jeopardize the claim. So silence may well give rise to the insurer or reinsurer being stopped from raising the point to defeat a claim. So if insurers during the claims process ask you for some documentation, let's say it's your management accounts, yeah? And you say, well, what have the management accounts got to do with the fact that my warehouse flooded? No, you're not having it, okay? Now, Insurers have to say to you, look, by not giving us these management plans, you're not cooperating under the terms of the policy, and therefore you're jeopardizing whether or not we pay your claim. They have to tell you that now. Again, in the old days, insurers would just go, oh, okay then, it's fine, that's up to you. Don't give us them then. And then when it comes to paying out your claim and going to court, if they don't pay, they say, well, they didn't cooperate with us. There's clearly a claims cooperation clause there. We asked them for all this material, they never provided it. Sorry, that's why we haven't paid. But now they have to tell you that if you're not behaving well, I suppose is the best expression, during the claims process, then they will be able, and they must inform you. Construction insurance, right? I think, as we all know now, construction insurance is now getting ridiculously expensive. There are a number of reasons for this, which I will very briefly touch on. In 2018, Lloyds did a review of all their syndicates writing professional indemnity construction business at Lloyds, and found that they were not charging enough premium, and basically gave them two options. You either write the business at a sensible premium or get out of the business. A number got out. And it's a bit like a toy at Christmas. If only one shop is selling the best-selling toy at Christmas, it's likely to charge exactly what it wants for it. If a number of shops are selling the same toy, then there's competition and prices go down. So the 2018 review, in effect, reduced the competition level. Secondly, there is the impact of Grenfell, the tragic events there, and the inquiry that's ongoing. I'm sure you and I, though no one actually knows yet, but there are rumours that the judge is going to find there was a conspiracy theory. All of these people who took part in the Grenfell refurbishment were insured, and insurers are not looking forward to having to pay the indemnity costs in relation to that. In addition, there's been a couple of what's called market-wide losses. That means losses that affect every class of business, because every class of business has to contribute to them. One of those was an aircraft called the 737 MAX. So a combination of that has certainly meant that insurance premiums for construction business have gone up, and your professional indemnity policy has gone through the roof. You will also find as well that it is virtually now impossible to get any cover whatsoever for cladding, combustible materials, fire, or anything. All new policies are excluding it. So those are overall general comments. How long is the premium increase likely to last? Well, I can't see much change in it for the next 3 to 4 years before it gets anything like getting some reductions in. So we are in for a very hard time. So what compulsory insurances do you have to carry? Actually, the only one the construction industry has to have is employer's liability insurance. Interestingly, that under the JCT, well, you get public liability insurance, and you get your contractor's all risk insurance, your car. But be mindful of the design exclusion. Remember, it can be bought back for new build contracts. I don't think people pay enough attention to their contractors all risk policy. It's quite long, and I think people sometimes get a bit bored with it. Don't. And don't just read the summary that's given to you by your broker of what you're insured for, or indeed your underwriter. The summary will be a 3 or 4 page document, and it will just set out you're covered for. You're insured for X amount in relation to this, X amount in relation to that, Y amount in relation to that. Yeah? That's not your policy. You need to read your policy wording. This will be a lengthy document, 60 pages or more, but that is the contract that you have entered into with your insurers. It is not your summary page. That's just the best the law says about that is it's evidence of cover. So it evidences the fact that you've got insurance, but it's not your actual insurance contract. I cannot stress enough how important it is to read your policy wording. Make sure you know what you're covered for, what you're not covered for, what you must do, and what you mustn't do. So I'll give you an example of that. At the time of when COVID first started, a number of construction businesses decided, rightly, to concentrate on some sites, and for example, on new sites where they may have just started work, to basically leave those, we'll concentrate on finishing these first. Perfectly sensible decision. But what they didn't do is you have to notify your insurers if you are going to leave a site in most insurance policies unoccupied for a period of more than 30 days. Otherwise, your cover goes. Now, most people didn't do that because they didn't read their policy wording. Okay? So it's important that you read it, as I said. I cannot stress enough how important it is to read it. If when you've read it, you don't understand it, speak to your broker, say, what is this mean? And some of the wording is, even though they're supposed to put it in plain language, still a little difficult. And if you don't think you've got enough cover, don't just sit there and wait. Oh, I'm not sure about that. Go back to your broker and say, we need more cover for this. Also, remember that insurance is a living document. So if during the course of a year, you decide to do a different type of construction work, that which you've done before, and different to what you disclose to underwriters, don't think, oh, it'll be all right. It'll be fine, I'll have some cover for that. You probably won't. It's easy then to, drop a quick line to your broker and say, we're taking on this new type of work. Will you advise insurers? Is there going to be an increase in premium? Most times there probably won't be. But your insurers then know, and they can't come back to you if there is a claim in relation to this new work and say, well, we're not paying for that. You didn't tell us. So tell them. If you're changing your type of work or what you're doing through the year, tell them. Construction insurance, let me give you an example. A steel frame building with roof completed, cladding completed, and dwarf brick wall completed. Nuts and bolts used in the construction of steel frame proved to be inadequate and the whole structure collapsed, damaging everything. The various defect exclusions would limit indemnity as follows. This is under your car policy. DE1, if you click that option, all damages would be excluded. DE2, all damaged items excluded except for the dwarf brick wall. DE3, steel framework excluded, roof cladding and dwarf brick wall paid for. DE4, only nuts and bolts excluded. DE5, all damage paid for, but improvement costs not included. Remember, in your contractor's all risk policy, you will have a number of options. Make sure that you've spoken to your broker and you've understood what those options are. Because just looking at that example, you can see that if you picked DE1, oops, you're paying for all the damage. If you pick DE5, you're fine. And if you pick DE3 or 4, you're okay. DE3 is actually the one that most people go for. It's the middle ground, and that's fine. But be careful when you look at your contractor's all risk policy. Make sure you have chosen the right option for your business. DE1 is a total exclusion of all loss or damage. DE2 excludes property that is defective and property which provides support on property and gives cover for other property defect. DE3 excludes property which is defective but gives cover for other which is free of defects and is damaged by defective property. DE4 is similar to DE3 but restricts the exclusion to any component part or individual item which is defective. Note that DE4 was originally intended for machinery erection risks where an individual component could be identified in the machine as defective. And DE5 provides full cover for both defective and non-defective property provided there is actual damage, even if only to the defective part. Cover is not given for the existence of defects. The costs of redesign are excluded. So remember, talk to your broker, pick the one that's right for your business. What else should you consider taking out insurance for if the aim is to make sure that your business is fully covered for all eventualities? Well, consider taking out directors and officers policies. There is a good deal of education going, health and safety education and others, which all can involve directors and officers of the company. You want to get them insured to protect them against that, and you can take out a D&O policy which will pay the defence costs if there is a regulatory breach. It won't pay the fine. I suppose it certainly won't keep you out of prison if it's bad enough, but what it will do is pay your defence costs. So you can get a good lawyer, come and defend you, and as there is more and more regulation in construction, there are more and more prosecutions, some of which can go to the directors and officers themselves. So always consider possibly taking out a D&O policy. Cyber attack. The insurance industry has reported there has been a 45% increase in cyber attacks since the start of the pandemic. I've had quite a few, you know, we're about to cancel your national insurance number. Oh yes, the one I had the other day was, please contact HSBC Bank. There is an error in your account. Well, I don't bank with HSBC, but it was a nice try. And there's a number of other schemes as well going on out there, including, in particular at the moment, an outbreak of impersonating solicitors. Would you believe it? So consider taking out a cyber policy to protect your business. We're all now very much more reliant on our computer systems than we probably ever have been before. Make sure that you have something to protect it. Cyber policies are very good. They provide helplines. They provide specialists in the event of someone was trying to hold you to ransom, in relation, say, to your client list or whatever. They have specialists that come in and give you and assist you to deal with it, etc. So it's worthwhile thinking about. It has gone up in cost in recent years, obviously, but it's still relatively inexpensive. It may be worth thinking about. If you have key employees, some of whom perhaps travel abroad to do international construction business, etc., instead of taking out a key man policy on that covers you for all sorts of things in the event that problems occur. Pollution, PLI, one event, sudden accidental cover. Yes, that's fine. There is some there. Product liability, professional liability insurance covers that. In some construction all risk policies, some policies cover cleanup costs up to $1 million, but you can always buy site-specific pollution. Of course, it's expensive, but again, you need to consider what the cost to the business would be if something seriously went wrong, as opposed to paying the additional premium. Professional indemnity, you have a duty of care to others. I think you all know that. And if you take out professional indemnity, it avoids the issue of whose design error it was. But as I have said earlier, and I cannot stress enough, professional indemnity policies now are exceptionally expensive. They're only likely to increase in value. The amount of cover that you're getting has decreased dramatically, and therefore you need to think very carefully about cost versus benefit. My advice would still be to have professional indemnity insurance if you can get it, but the costs are becoming prohibitive. You need a good broker. The best way to make sure you can get professional indemnity cover is to start the broking process early. Don't leave it till the last minute to give the paperwork to your broker. He will not, in this market, be able to do very much for you, or if he can, you'll be paying top dollar for it. You start early, so before your policies are due to expire, the more chance you've got of getting some decent cover at a decent price. Leaving it to the last minute is not going to do the job this year, and probably for the next 3 or 4 years. It's always as well, if you want to take it a stage further, you can always ask your broker for you to go meet your underwriter. Sometimes that's good because you can explain your business directly to the underwriter yourself and say, well, look, we are very good. We have never had a professional claim in our 20-year history. We are very careful. You might get cover then. But as I said, it's going to be increasingly difficult to get it. It's going to be increasingly costly. And the best tip is do not leave it to the last minute. So, conclusion, make sure you comply with your disclosure obligations. Having said that it's only relevant information, if you are in any way unsure as to whether you should disclose it or not, the advice has to be, yeah, or at least speak to your broker and say, do they want to see this, do you think? And he'll tell you. Mind your excesses on your policy. Is the trade-off for a lower premium worth it? It certainly wasn't for poor old Ted Baker. So don't just rush into having huge excesses because it keeps your premium down. Ultimately, you have a claim, you're paying those. Make sure your business can afford it. Read your policy wording. I sound like a broken record on this, but it is so important. And the number of people that come to a firm for advice haven't read their policy wording. They've read the front 4 pages and thought they've got cover. When you look at the policy wording, they haven't. It is so important. It is the most boring read ever, but it has to be done. Notify insurers of any changes to the risk in a policy year. As I said, if you're going to take on a new type of business, tell your insurers. If you're going to take on a new type of construction work, tell your insurers. That obviates so many problems. They can't then come back and say, well, you didn't tell us you were doing that. Not in your proposal form. We're not paying that. But if you can say, well, we did tell you, here's the email from our broker to you. Oh, right, okay then. Now beware the loss adjuster. These are probably the best tips in terms of getting your claim paid. For major claims, insurers inevitably appoint a loss adjuster. Okay? It really goes back to the fact that an insurance policy is designed to put you back into the same position you were before, not better, not worse. And insurers want to ensure that that's exactly what they do. Yeah. So they will send a loss adjuster around. First of all, make it look to the loss adjuster as if you are doing everything you can to continue to run your business. So if you have had a warehouse flood, don't leave everything floating around on the floor. He won't like that. Even though you can see that you've made efforts to salvage what you can, that you're going to sell certain items which are damaged beyond repair, but etc., then he'll be far more willing to report back to insurers and say, these guys are really trying. You know, they're really trying to get back on their feet quickly. You know, we need to do something. But if a loss adjuster turns up and he gets the impression that you just insurers will pay for it, he's not likely to be as cooperative. Look after him where he's whilst he's there. Make him a cup of tea, you know, make him feel welcome. If he asks questions, answer them honestly and truthfully, and make sure you've read your policy wording and your policy documents before you meet him. Yeah, he is an important part in the claims process. And if you get on well with your loss adjuster, you make a good impression, he's far more likely to be of assistance than one that just thinks, well, they just think insurers are going to pay. Yeah. The last point to remember is this, that in the event that you have a claim, until cover is confirmed by the insurer, so he says to you, yes, we are going to pay for that, you have got to act as if you were uninsured. So, going back to my warehouse example, until such time as the insurer says, yeah, that flood damage, that is covered, you have got to pretend that you have no cover at all. So that would mean getting the stuff out of the water, selling what you can. You've got to act as a prudent uninsured. Just one little caveat. When the Enterprise Act was introduced, There was a clause in there to do with insurance, which everyone was a little bit surprised about. It's an enterprise act, what's it got to do with insurance? But what the legislators wanted to address, and I think it is quite, and it is true, regrettably, is that sometimes, and if you'll pardon the vernacular, when you make a claim which is undoubtedly covered under the policy, insurers faff about. And they come up with all sorts of excuses not to pay the claim, even though there is no defence on their behalf. So the legislator, didn't come out right, sorry about that, decided to do something about it and said, right, if the insurers do not pay a straightforward claim promptly, then you can now go to court and get compensation by way of perhaps additional damages, possibly interest, etc. It's the first time this has happened, but they've put it in there to try and stop insurers on straightforward claims just faffing about and not paying you. And that clause was then put into the Insurance Act of 2015. So remember, it's there. It's a good little thing to throw at your insurer occasionally if he's not behaving himself. To say, look, this is a straightforward claim. It's now been 4 months. Where is payment of our claim? Okay. Now, obviously, if it's a complicated loss that needs adjusting, then it's not going to work. But on a straightforward claim, it is there. Conclusion? Well, I don't think I've really got very much else to say other than what I've said already. So I shall hand you back to Julie. Good morning, Julie. How are you?
Good morning. I'm fine and glad to hear you've managed to squeeze the words, read your policy wording into a seminar, as always. Very proud of you for your
several times, I think you'll find, Julie.
Several times with gusto. Okay, we have a couple of questions for you, John.
Mm-hmm.
Someone's asking, is it possible for the employer to successfully rely on CAR if taking partial possession or sectional possession of part of the building?
I would have thought so. There shouldn't be any reason why not. But again, it's all to do with notification and informing your insurer. Yeah, if you tell, what people don't understand is if you tell your insurer what you are doing, and or even just ask the question of your insurer, I'm going to do this. Will I be covered? I'm letting you know I'm doing this. People don't communicate enough with their insurers and tell them what they're doing. And then they're surprised when they turn around and say, we didn't tell us. So the more communication you have, but I don't see under those circumstances why you wouldn't be covered. But again, write, inform, get a decision, and then you'll know.
Yeah. Okay. The next question up is, do construction clients or their project managers have an obligation to check the contractor has the correct policies and appropriate cover or wording in place?
Well, that's a very good question. That's one I've been asked on several occasions. The answer is, I think, yes. What tends to happen, and this is, I suspect it's just grown up, is that, oh, have you got insurance? And they waive the 2 or 3 pages that they've got from the summary in front of people. Oh, yeah, it's all here. But as I've said, all that tells you is your limits of indemnity. Mm. It doesn't tell you what you're actually covered for. So, for example, the policy wording may say, I'm just using a very simple example, may say, you're not covered for any men working over 18 feet. Now, you won't be able to tell that from the 3 pages they've waved in front of you. So what you really should be checking is whether the role that that person has in the construction project, has he got cover for doing that type of work? Now, that won't need you having to read all of his policy wording. It'll probably mean that you need to see 4 or 5 clauses. And if you say, look, I just want to make sure that you're covered for doing this type of work on this project, can I see those sections in your policy wording? That even if the guy can't find it himself, it's a 2-minute email to his broker to say, I'm doing this, which clauses under the policy will I covered under? People don't do enough in terms of that. They just accept the 2 pages. Well, that doesn't tell you anything. That says you've got cover for £1 million. Well, great, marvellous. But exactly what am I covered for that £1 million? Oh.
Yeah.
So yes, you should be checking.
Okay. When there is an option for an employer to insure the works or to ask his contractor to do so, do you see any advantages or disadvantages for either party?
No, apart from I suspect practical ones. Whoever's got their best claims record, or possibly the best broker, or possibly the best insurer, they're the people that should be doing it. Look, if you take the view that you are all in it together with regard to insurers, then you should really all be cooperating with each other and seeing the best solution to the problem. But the insurers are getting, well, certainly were, they are not quite so much now, but they were getting used to a more collaborative approach from those involved in construction projects. It was partly to do with the NEC, it's also partly to do with the JCT Constructing Excellence contract. They had to adapt the policies to allow a bit more collaboration, a bit more risk sharing. Now, that certainly was the case before the pandemic and before the issues at Grenfell. But, you know, you can make both, there's no harm in both parties making a joint approach to their insurers and saying, look, what's the best option? And speaking to their broker, saying, what's the best option? That's the way to do it. It shouldn't be, insurance should not be combative between the parties. It should be, we all need this. What's the best solution to get it?
Yeah.
The approach should be taken.
Okay. Well, that appears to round up all of the questions for this morning. So thank you very much, John. That's great to have your time and your expertise as always. Thank you to everyone for attending. Our next seminars, next week, we have Connor Ahern with his QS series, and he will be talking about concurrent delay. And then in the evening at 6, we have Richard with his Construction Essentials series, talking about payments, including smash and grab. So if you'd like a place on either of those seminars, please email me. It's seminars@silverllp.com, and I will book you in and send you the login details. Other than that, have a great day, everyone, in the fabulous weather we're all currently experiencing, and we hope to see you all again soon. Thanks again, John.
Thank you again, Julie. Thank you, ladies and gentlemen. Have a good day.